An example of the efficiency ratio is the days sales and payables ratio, which is also called the days payable outstanding ratio. The days payable outstanding formula is 365 divided by the payables turnover. We can substitute directly in this formula if we calculated the payables turnover ratio earlier. The payables turnover formula is the cost of goods sold divided by the accounts payable. Or we can rewrite the days payable outstanding formula as 365 times accounts payable divided by the cost of goods sold. We get the accounts payable from the balance sheet and we get the cost of goods sold from the income statement. Please note that the income statement is a flow account, which means that it is calculated over a year, while the balance sheet is a stock account, which is calculated on a certain day. Since we cannot compare a year to a day, we need to convert a day into a year by getting the average of the two balance sheet items. So, we'll use one income statement and two balance sheets. In summary, anytime you find a financial ratio that includes an item from the income statement and an item from the balance sheet, you will use the income statement item and get the average of the balance sheet items. So, we can rewrite the days payable outstanding ratio as 365 times the average accounts payable divided by the cost of goods sold. Let's calculate the days payable outstanding for the year 2018. Equals 365 times. Let's look at the balance sheet for accounts payable. Please note that in 2018 it is the first year of operations. Consequently, we do not get the average of the accounts payable as we do not have the previous year. We have accounts payable in the year 2018 of $5 million. So, in our formula, we will multiply by accounts payable of $5 million, divided by the cost of goods sold of $30 million, which is equal to 60.83 days. The unit of the days payable outstanding ratio is days. It means that payables are paid, on average, every 60.83 days. The longer the days payable outstanding, the better. Next, let's calculate the days payable outstanding for the year 2019. Equals to 365 times. Let's look at the balance sheet for the average accounts payables in the year 2019 and 2018. We have the accounts payable of $15 million in 2019 and accounts payable of $5 million in 2018. So, in our formula, we will multiply the average accounts payables of, open bracket, 15 million plus 5 million, close bracket, divided by 2, divided by the cost of goods sold in 2019 of 38 million, which is equal to 96.05 days. The unit of the days payable outstanding ratio is days. This means that payables are paid, on average, every 96.05 days. The longer the days payable outstanding, the better.